Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this week's podcast, I'm going to talk to you about the flat corporate bond yield curve and how to invest in this yield curve. Okay, now just to explain what a flat corporate bond yield curve is, when 2 to 3 year or even 5 and 10 year bond yields are trading almost in a very low difference between each other. Normally, the if the lower the maturity, the difference between a lower maturity bond and a higher maturity bond of the same issuer is should be what there is a large difference, largely because of rising inflation expectations. But with this market now becoming very flat, the 2 to 3 year bonds are almost at the same level. Just to give you an example, Bharti Telecom today issued a bond, 2 and 3 year bonds. A 2 year bond was at 8.77% and 3 year bond was at 8.80%. Sundaram Finance, the South-based lender, they issued a 2 year bond at 7.9% and 3 year bond was at 7.96%. So this is the difference between the 2 and 3 year bond. And what should investors do? Should they invest in the 2 year bond, or should they invest in the 3 year bond? Now, clearly, if the difference is much very less in terms of spreads, that is, if 2 year bond is at 7.9% and 3 year bond is at 7.96%, not too much of difference. And 2 year bond gives you a lower risk in terms of if interest rates move up, then the risk is much lower because your money comes back faster. Having said that, if the feeling is interest rates are going to go down in the next 2 years, then the 3 year bond makes more sense, because investors can still get extra return for the extra 1 year, and they don't have to worry about reinvestment risk. And again, the 3 year bonds also, the investor is protected against interest rate higher rising very sharply. But the protection is less than a 2 year bond. So investors can definitely take a call on which part they can invest in. The 2 year bond can serve its purpose if they want lower interest rate risk. The 3 year bond can serve its purpose if they want uh, lower reinvestment risk. And just coming back to the market levels, in the private placement market, we saw Navi Finserv issue 1 year bond at high levels of 9.5%. Clearly shows that there is a tightness in liquidity in the market. Then we had Kotak Mahindra Prime issuing 2 year bonds at 7.9%. You have Tata Capital Housing Finance issuing 3 year bonds at 7.89%. You had HDB Financials, the HDFC subsidiary, issuing 3 year bond at 7.96%. You had Bajaj Finance issuing a 3 year bond at 7.9%. Most of these companies have been issuing bonds at these levels. You have JM, SIDBI, again Kotak Mahindra Prime issuing 3 year bonds at closer to 8%. Aditya Birla Finance issuing 4 year bond at 7.95%. So all these issuances seem to be in these kinds of maturities. You had going up, you had A Financial issuing 5 year bond at 11.2%. You had then you have PFC issuing 15 year bond, but those are at lower levels, closer to 7.65%. And PFC MTNL, which has had government guaranteed, central government guaranteed, issued 10 year bond at 8%. Then this is good for PFs and other, but it doesn't see too much of institutional interest. And Power Finance issued 10 year bond at 7.65%. So these are the market levels. Clearly, given that longer duration bonds, including 5 to 10 year bonds, are around 8% or just over that, some below 8%. The 2 to 3 year bond in a 7.9% to 8% levels for good AAA issuers are looking very reasonable for investors looking to invest in corporate bonds. And for financial advisors wanting to investors to gain extra returns than what is available in other products of similar maturity. These bonds can serve that purpose. Thank you very much for listening in to Let's Talk Bonds. Follow us on all podcast channels and get the best investment options available for you on fixed income with the most information and knowledge that I can give you on the Let's Start Bonds podcast.